I know your time is valuable, so I'll get right to it. Throughout this episode, I'll be giving out the exact strategies that took me from £100,000 in bad debt to building a $13 million portfolio. But this journey has given me more than wealth. It's inspired a mission to help everyday people like you take control of your financial future. So every week, my team and I pour everything into bringing you market updates and proven strategies because we genuinely believe that everyone deserves financial security. No gimmicks or empty promises, just real insights from someone who has walked this path. And to help spread these insights to others who need them, I truly appreciate if you could subscribe to our channel. When you hit that button, you're telling the algorithm that our content is valuable, which helps us reach more people who deserve this opportunity. You're joining a community dedicated to financial independence for everyone. If you do subscribe, here's my promise. My team and I will make this show better for you every week. We'll listen to your feedback, answer your questions, and continue supporting your journey to financial success. So thank you for being part of this mission.
And welcome everybody to the Lunchtime Investor with myself, Marcus de Maria. And of course, we have Keith Sullivan in the house as well. And episode 15 is all about, is saving money keeping you poor? Because in reality, I think we're used to people saying, get a job, save. Is that keeping you poor? Now, remember what this is all about. You eat and we talk. So welcome to the Lunchtime Investor. So what do you think? Is it important to save money?
Back in the day when I was growing up, all my parents...
You're so old.
I'm getting way too old. But all my parents were talking about is, first of all, my mum was always saying, money never grows on a tree. That's the first thing. But it is true. But then it's always about saving. It's like save for your future, save in the bank, save for a new house, save for your car. Like it was always a term of saving. And it was only the last couple of years that I realized that doesn't work. And I think we're going to go a bit into depth on today's meeting.
So it doesn't work. Okay.
Yeah,
so what we're going to reveal, we're going to reveal the secret killer of money in the bank. Most people don't realize, right? Because they keep their money in the bank. Saving alone without doing this thing that we're going to talk about is an absolute trap. And then our strategy to beat the banks. More than beat the banks, I mean, flipping heck. So, but why don't we start saying hello to everybody in the chat. Hi, everybody. We got the Centurion, as always. Hey, guys. What do you think, the biggest threat to your money in the bank? That's my question to the people on the chat. Hi, Annie. Hi, everybody. What is the biggest threat to your money in the bank? What do you think? I'm going to give you a second to reply to that. What do you think the biggest threat is?
I think there are two big threats in the bank. Number one is when you put your money in the bank lends your money out. So it's physically not there anymore. So then what happens if the bank technically goes bankrupt? We saw it in America during COVID, where you saw a couple of regional banks go bankrupt and have to get bailed out. That is the risk that you're taking. If you're putting your money in the bank, they're actually using your money to loan out to other people. So your physical money that you see on your checking account is not actually there. So that's number one.
This is this fractional, what do they call it? Fractional reserve lending or something?
Correct. And they're actually making money on lending your money out, but you're making nothing on it, which makes
Did
no
I
sense.
give them permission to do that?
No. But
I must have in the terms and conditions.
There has to be something that you give permission. When you put your money in the bank, there has to be something that goes, do you know what? We're allowed to lend your money out.
It's almost like it's no longer your own money. Okay, so that's the first thing. What's the second thing?
The second thing is the silent killer, which is inflation. Inflation is always about everyone. We see in the news right now that inflation is coming down, right? Everyone's getting excited. Inflation is dropping. That's not actually the case. Inflation is always growing. Like it or not, we're
always growing. What do you mean it's
growing.
always growing? What do you mean?
If you look at inflation, I'd always look at it as like being in a car, okay? Imagine being in a car and doing 100 miles an hour.
Okay.
You're going forward. So you're like...
I'm on the German Autobahn.
And you're hitting 100 miles an hour. You're going forward relatively quickly, right?
Yeah.
Imagine you go and do 50 miles an hour. Guess what? You're still moving forward, but not as quickly.
Oh, I see.
And that's what inflation's doing.
Oh, I see. So every year, the costs of goods is increasing.
Correct.
But sometimes a little bit more, sometimes a little bit less, but it's always increasing.
Correct. So you had inflation, say 5% year on year. That is a 5% increase. Then it's 2% year on year. That is still 2% on the previous year.
Yeah.
That is increased. And people think, oh, it's coming down, everything's getting... No, it's still costing more for goods and services.
Do you know what it is at the moment?
It's in the US, I think it's around 2.2, 2.3.
Since we live in the UK.
In the UK, You put me on the spot.
I think it's about 3%.
Something around just over 3. I think it's 3.2.
I think it's just about 3. Let's see what people are saving here. Saving? I got saving on the brain. We don't want to save. Let's see now. Okay, bad interest rates. Right? Yeah, it doesn't grow in the bank. Hello, bank saving rates are very low. You will have to wait many years to earn a lump sum. Banks can also withhold your money. Tell us more about that. What? The bank withhold you? I think you talked about this on the last episode. So tell us more about that. Have you got it yet? And then, Leslie has said it as well. Hi there. No growth, just inflation. Oh, in Lebanon, bank customers are taking guns into banks to withdraw their money. Well, that's quite effective, I would assume.
I mean,
in the West, that was like...
But I'm sure that's robbery, no?
Yeah, it does.
Unless it's your own money.
Oh, it's your own money. Give me my own. This is a stick up. Give me my own money. Sorry, we shouldn't be laughing. So where do you keep most of your money? That's the next question that I really want to ask in the chat now. Where do you keep most of your money? So go ahead and let us know. Is it A, in the bank? Is it B, investments or trading if you're doing it more short term? Or is it C, is it in property? Or we should have a D, maybe some other kind of investment. But let's say in the bank. Investments and trading. I mean, most of your money. Where would you keep most of your money? Is it in the bank? Is it investments, trading, and investment property? Where would you keep most of yours? Or where do you keep most of yours?
So for me now, no, in the bank. If you have a look at it this way, the bank is quick enough to increase interest rates on you. So if you've got a mortgage or a debt with the bank, they're happy to increase interest rates.
But then they're not so fast at decreasing them, right?
Decreasing.
There's a lag time.
There is a lag time on that. But also, imagine that. We're happy to increase the amount that you have to owe us. But we're not happy to increase the savings rate you're going to get for staying with us.
But is there anything we can do about it? It's just like fighting the wind, you know?
You are.
And this is why it's kind of like this alternative. It's not going to replace it, I don't think, but an alternative. So you have the choice between the current banking system and cryptos is one way that people are going. Let's see what people are saying here. We've got the poll going. Let's have a look. Oh, how this is really interesting. Make sure, everybody, you vote. We've got another 5 seconds, then we'll take it down. Let's see. Where do you keep your money? In the bank. So, people are still voting. Let's take it down. 3, 2, 1. Go on, choose one. Here we go. And take it off. Let's have a look at the result. And where do you keep your money? Let's see. Investments and trading, 63%. In the bank, 27%. And property investments, 9%. So, we've obviously got some people who are trading and investing here. So, hello to some of our members here, I'm sure. Let's see. I did get my money in the end, Marcus, but it took a week. I informed the FCA like magic. I got my money. Wow. Okay. Wow.
But don't forget, the FCA...
The big guns.
The FCA only cover, what, 80,000? Is it now?
I think it's £80,000.
Yeah,
yes.
£80,000. So imagine that you have a bank and you've got 100,000. What's going to happen then? You get 80,000 back, but you lose 20,000.
No, but and that's just as a consumer. As a business, let's say you have 1 million or so, you don't get anything back.
Yeah.
Because you're a business. You're not. It's like, what? How the hell did that happen? Okay, so let's keep going then. Oh, there's a video here. Should we watch this video? Now, I'm going to take some notes, which hopefully you should be doing as well. I want to be ready for this. We're going to play a video. Can we show the video?
If you don't save money when you're broke, this is the thing no one's telling you. If you don't save money when you're broke, I'm talking about $10 a month, $20 a month. The crazy belief system in the world is that you will save it once you make more. If you have a habit of spending...
Oh, we're going to play it again. Hold on. Let's play it again. Here we go.
If you don't save money when you're broke, this is the thing no one's telling you. If you don't save money when you're broke, I'm talking about $10 a month, $20 a month. The crazy belief system in the world is that you will save it once you make more. If you have a habit of spending, you will spend more when you make more. I know a lot of people who make a lot of money who have a Lamborghini or a car or a house that are dead broke. Dead broke. You all would be shocked by who's really rich and by who's really broke.
Yeah.
You'd be shocked because you either are a spender or you are a saver. When I was 26 years old, I made $750,000 that year, and I was living in a $750 a month apartment.
He must be. I'm guessing he must be a saver there, because if he's basically earning $750,000 a year and he's in a $750 a month apartment, I'm assuming he's not a spender. I'm assuming he's a saver. I mean, that's good money management. I applaud him. I think that's absolutely fantastic. I'm for you. That is amazing. Most people say I'm crazy, but I'm absolutely for that. Let's see. What did people think of that video while I talk to you about that? Any points that came up there?
I think one of the biggest things is the mindset that people have, right? If you're a saver, then you save your money. If you're a spender, you'll spend your money. But there is also a middle ground to that. You have the savers, you have the spenders, and you've got the investors. The people in the middle that actually know, right, I can't have my money in the bank because it's not doing anything for me.
Yeah, but the thing is, though, Keith, when you're talking about like the different archetypes, right? So let's say you were taking a spender. People are spenders. You have a saver. People are savers. People are what we call money mancs. I learned this from T. Harv Eker, money manc amongst they're above it all, And then there's the avoider. They're the ones, I don't know whether that's you. Tell me in the chat if that's you. You actually don't open the mail when it comes from the bank or the credit cards and whatever, right? You're not an archetype, which I am an investor. You can become that identity after you learn, but you don't grow up that way, right? So you're right. We should all, I think that, just being a saver, you cannot save your way to being wealthy. No. Impossible.
But you said one thing, that we don't grow up being that way.
Yeah.
In society right now, how do kids grow up? They grow up with adverts, TV, I want. And all of a sudden, they become spenders once they've got money.
Listen, it's always been that way. You look at a red bus going by, you look at the side of it, you think it's just red. There's advertising, spending. Whether it's a theatre show or whether it's clothes, it's spend. When we were literally, somebody do this, walk along the road and just see how many times you're sold to. Of course.
Yeah, and it's never taught in schools about how to save money. Actually, it is starting, but any money management, when I was growing up, there was nothing about saving. There was nothing like that. It came from my family. But again, it was all just about spending. You wanted the new shoes. You wanted a new jacket.
By the way, why should it come from the schools? Why it should be parents? Why?
No, it should be.
The teachers aren't going to be. They probably don't have any money to save anyway. So it
but
should be the parents.
If you have a look at this way, the schooling system is there to set you up for life. That's what the school system is there to do. Okay? It is, right?
To set you up for life. It sounds like I'm set for life.
No,
set me up for life.
It's meant
to prepare you.
To prepare you for your future. It's meant to give you the education that you need to go into the real world and survive. That's basically what school is there for.
Survive.
It's a survival mechanism. But is money management not a survival tactic that you need to learn in schools? Yes, it should come from your parents. Obviously, your parents should have that. But don't forget, the parents have already predetermined views about money because of the way they grew up. Okay,
so you're saying there should be like best practices on how to budget.
Correct.
The dangers of credit cards, how to not to get into debt, because people don't know, right? As soon as they're 18 or 17, they get an application for a credit card and they go, oh, this is brilliant. And now they go out and they want to be liked, so they start spending money for their friends and all this kind of stuff. Before you know it, they're in debt. And I tell you what, the spiral. Yeah. Because I was once in, and I tell you, the spiral, it goes fast.
And it's also like you were saying about driving your friends around. What's the one big form of debt? People get into financing on cars. They get the brand new car, they get all of this, and all of a sudden they can't pay for it. I fell into that trap. When I was younger, I got into a finance deal, had to pay a balloon payment at the end of it, then got into another finance deal where I refinanced to then be able to come out of that. But then it would all
What about having a private number plate with XRP on it?
I wouldn't say it's private though. I think that's just a happy coincidence. I did not pay for it. So everyone is aware, my number plate has XRP on for Ripple, but I didn't pay for it. I think that's the biggest thing.
You didn't pay for it?
No, it came with the car.
Oh, no, you're kidding.
No.
Well, all this time, and I thought that you really were an XRP fan.
I am an XRP fan.
That is manifestation. That is, wow.
It does help.
You visualized and brought that into your life. Let's see. People are saying it's good mindset. Me too. I'm a saver, but I like to spend a little. Nigel says, intrinsically, investors are spenders. Would you say that? Investors are spenders? Because I am a saver. Oh boy, am I a saver. Like big time. But now that I've learned how to invest, I am putting all of that. I mean, literally all of the money is liquid. Yeah. It's not in property where I can't. It's liquid, stock, shares, gold, precious metals, of course, commodities, and cryptos and stocks. That's it.
Would you say that saver mindset comes into your point of view with investing where you have to sell to take profit? Do you feel like, something like Bitcoin, I want to save Bitcoin and not actually take profit off the table?
I mean, I just sold 7 Bitcoin at 120,000. It was so hard. The very first thing that Eamon said to me, I bet that was hard. Yeah. He goes, yeah, that was so hard. He knows me. I mean, we've known each other for years and years and years, 8-9 years. So it was absolutely difficult to do. But I'm just following the strategy. That's what I'm doing.
Of course. And I think that's one thing. Once you learn a strategy, you don't allow emotions to dictate what you do when it comes to buying and selling. And on the investing side, one of the biggest things you taught me when I joined Investment Mastery was spend less than I earn for my critical net worth. That was one of the biggest things.
That's it.
And then the next lesson that came from that is you then invest the difference. You spend less than you earn and invest the difference. And that honestly has got me into such a better financial position that, yes, I'd still have money in the bank because it's a safety net, right? We always want a safety net.
We cover that on the one day, right? It's the 4 steps. And then you keep going until you achieve your critical mass or your critical net worth.
Correct.
Right, let's continue here. I don't know whether I can carry on. Yeah. Okay, let's have a look. Here are some common savings opinions that people have. For example, saving allows for more flexibility because you have some cash in the hand. That is true, right?
Of course.
Yeah.
But again, what if you understand the cash that you got in the bank is just a safety net to fall back on in case something does come up?
So it's like an emergency fund.
Like all of a sudden the car breaks down, or you have a leak in the house, or something.
Because
that you
some
need to
people
pay.
say you should have 3 to 6 months worth of cash in the bank just in case. What do you think of that?
I think in terms of that, yes, that's being very prepared, but you need to have that mindset of, okay, that's not going to make me money.
Right, and that's very important because as soon as you start doing that, it actually keeps you away from investing that money. Because, I mean, 6 months worth. Yeah, have maybe 1 month or 2 months. But remember, in something liquid, I can sell cryptos. It's back in my account within 24 hours. I can do that with stocks. I can do this with my, digital gold, my digital silver, my digital oil, and all this kind of stuff. So I think that's important that you don't go, I don't need that, and put it into. And I love property. We have double-digit property portfolio. But the point is that money is stuck there pretty much.
Yeah,
right.
And it can take months to get out. Whereas if I'm I am investing, but if I wanted to take profit on, say, one of my stocks investments, I'm able to take that as soon as market opens, and because it's in an ISA or SIP, well, SIP you can't really touch. But
See,
ISA,
even that, when the market opens, that's the old school. I mean, I have ISAs and SIPs as well, but in cryptos, it's 24/7.
Correct.
Like I wake up in the middle of the night, and go, oh, I need to do something. I can sell it right there and then. This is where I tell you, this is so much better. So much better. Let's see what people are saying here. There's a couple of wows there. I swear somebody's laughing at you, Keith.
because of the number plate.
Oh, I spent less than I earn. Absolutely. Spend less than you earn. Always have to spend less than you earn. Nice one. Okay, what about this next one? Interest can help you build wealth. What? Interest can... Oh, bank interest. What? Right, what's the interest rate in banks at the moment? 3%? It's
if you're
barely
lucky,
inflation,
if you're lucky.
2.5%?
Yeah.
So you're basically losing money still.
Yeah, of course. So inflation is always going to outperform what you're getting in the banks at this moment in time. So again, you need to understand the money you've got in the bank is a safety net that is not going to grow your wealth.
That's all it is. That's all it is. And the rest of it should be... I like what Janita's saying here. Money needs to keep moving, so we should not be saving all of it. Now, cryptocurrency, right? The dollar is a what? A currency, a current. It should be moving, because if you have, let's say, this water here and it becomes stagnant, a pool, the bacteria gets in and it becomes bracken, you will not be able to drink it. So that's why they call it a currency. It has to keep moving. The whole point is you need to learn how to keep your money moving. And it's a skill that anyone can learn. Well, by the way, would you agree with that? Anyone?
I do feel anyone can learn how to invest and trade, as long as they learn the right process.
Well, I would add to that then. I would say it's not just anyone. I think it's anyone can learn with the right strategies, but also the right support.
Yeah.
Whether that's coaching or other people just saying keep going or whatever. Well, probably support, coaching or something. Anyone can learn. Anyone can learn. Now, could it take longer for some people than others? Of course.
Yeah.
Just like anything. I know people... How James, our CFO, who was, by the way, who enjoyed... Were you there last week with James? I had James on the show, that debate about, is investing just a nice way of saying gambling or not? Anyway, I think he failed his driving test 3 times. So, but he drives now.
Of course.
And he drives very well.
I think I failed twice, and third time I passed.
You failed twice?
Yeah.
I failed once.
Once a bus pulled out
1,
in front
2,
of
3.
me.
Yeah, well, I mean, these
not my
buses,
fault.
you know.
They are. But I do think there's one thing that you are missing. The strategy, yes.
Okay, go on.
But I do think mindset comes into play there.
Ah, the mindset.
The mindset is
how
a
can I
crucial
forget
bit.
that? That's 80% of success.
It is.
Yeah.
And again, what for me that
So let's do that again. So anyone could do it as long as they have the right mindset,
strategy,
the strategy, and the support.
correct.
Brilliant, fantastic. By the way, if you want to learn any of the strategies that we've been teaching for 25 years successfully, all you need to do is to go below in the show notes or whatever it's called, and you can pick up your free copy of The Lunchtime Trader. So go ahead and do that if you want to. 25 years of trading and investing experience in there. By the way, don't get frightened with this word trading, right? It's investing, trading. It's getting into something which has a chance of growing up. Basically, an asset. An asset. Yeah, Annie, you enjoyed last week. Amazing. Fantastic. Okay, let's see. Investing. Ooh, how about this one? Investing is only for the rich.
Mm-hmm.
Is that right? Were you rich when you started investing?
Definitely not. Definitely not. And I think that is a bit of propaganda from the bigger players, the banking systems. Because what do they want? Rather than you feeling like you can invest and trade, they overcomplicate it.
Give it to me.
Give me your money and I'll make money on you. And that's the thing that a lot of people don't realize. It's either you put it into the bank and then the bank spends your money without you knowing, or you give it to fund managers and they make money on your investment. And then they have no risk. It is, but then they have no risk on the table.
None.
So that's why.
What risk do they have? None.
Of course.
Listen, I remember in the 90s when I gave them, there was this amazing brochure. It was so glossy, Keith. It was lovely, you know. And it had all these I didn't understand a word, but it was lovely, you know, like that, and all these like grams and pie charts, and it was all like, you know, triple your money in no time at all, blah blah blah. Anyway, so I decided to give them some money. Listen, they were down 70% at one point, 70. And you know, but by the way, do you think? Well, I'm going to ask people in the chat. Do you think that they maybe said, oh, listen, we were down minus 70, so we're not going to take our management fees this year, Mr. De Maria. We don't deserve it. What do you think? Do you think they did that? Do you think they did that?
Definitely not. Come on.
I mean, that's ridiculous, of course. By the way, most of it was probably the management fees. You know, maybe they didn't even invest it. It was just 4% and then 8% and then 12%, and it keeps adding up, right? But incredible.
Imagine that, spending 4% on management fees when you can just spend 20 minutes a day investing your own money.
But you need to learn how to do it, like riding a bike. You do need to learn. So is investing only for the rich? No. Do you know, I think it's more important to not on the amount of money that you have. Please write this down. This is very important. It's not the amount of money that you have. It's about starting as soon as possible, getting into the habit of doing it, because if you can do it with small amounts, you can do it with large amounts, right? And what you don't want to do is make your beginner mistakes on large amounts. So start with small amounts. In fact, we start people on a demo account, a virtual account, so that they can't even risk. I mean, how amazing is that? You can't do that in business. You can't do that in property. Like a virtual account, try out the strategies. Do they work? Amazing. Ooh, Annie says that is not true. No. What is not true? What is not true? Tell us what is not true.
I think the investing is for the rich.
Oh,
so I think that's what Annie is referring to.
In fact, that's probably how the rich get rich, but they do it with other people's money.
But that's a mindset thing for me.
Okay.
You have to allow yourself to be wealthy.
Ooh,
I think if
allow yourself to be wealthy.
Yeah, if you think that you don't have the reason or the opportunity to become wealthy, you won't become wealthy.
Well, there's all kinds of things. You say reason, you say opportunity. The very first thing is that most people are programmed to, I'm just not rich. Rich is for other people.
Correct.
Who are these other people? They're still people. And, in my family, we don't do that kind of thing. What does that mean? Like, so the first person to go to university in the family, the first person to start their own business, the first person, be that person.
Who's going to break the mold?
Yeah. So what do we think of this? We think having an emergency fund is important, yes?
I think it is important, but once again, keep going back to it of it's not going to make you money.
Right.
It's just a safety net in case
That's
something does go wrong. Yes.
So it's not I'm saving I'm saving up in order to become wealthy.
It's got to be a proportion.
Not going to happen. And you're running out of time.
Yeah.
That's the problem. And if you're not beating inflation, your money is shrinking. That's correct.
100% correct. If you're not performing 3% a month, 3% a year.
I like how you're thinking, Keith. See, that's how we think at Investment Mastery. 3%. That is actually how we think.
But if you're not performing 3% a year, then you're not beating inflation. Imagine working for a job. Is your job giving you 3% pay rises every single year to outpace inflation? Some are, some are not. So
I hope nobody from Investment Mastery employees are looking at this right now. Yes.
But some are, some are not. But then again, it's all about, right, I have a proportion of money in savings, because that's my safety net. But I've also got a proportion of my money in investing, which is going to make me returns. In VCA, our value cost average, which is in the book, that is generating around 15% yearly.
Actually, more than that.
As a minimum, I kind of give the lower end.
Yeah.
Because once you start talking about, again, this goes into a mindset thing. When you start talking about 30, 40, 50, 60%, a lot of people are so used to 1-2% in the bank. Yeah. They're like, you're lying to me. That's impossible. Yeah. My dad's the same, right? So the thing for me is when you are looking at the returns, always start on the lower end. What's the worst case scenario for some people? And the fact is, if you're outperforming the bank, you made 4% a year, you still beat inflation better than 90% of people out there.
You've got to make a lot more than that if you want to, because otherwise you're not lifting off, you know. I mean, for me, I mean, I'm going to say this: 15% a year has got to be the minimum.
Yeah, of course.
And it's really interesting. Once you focus on that, you will do what you have to do to make 15%. And the chances are you're going to make, you know, could be 14, could be 10, could be 25, but it's going to be around that. If you focus on 3% a year, guess what? You only do the things that will get you around 3%. And guess what happens? You make 2% or 1% or maybe 6%, but you're not going to make 15% because you're doing different things. Now, let me know in the chat whether that makes sense, because you're focusing on different goals, therefore you're doing different things. Yeah. So let's see what people are saying here. So Unita's agreeing with you, Keith. Your beliefs create your reality. Centurion, mindset matters so much. It really is. Marcus, I mean, it's not true that thank you, Annie. Fun videos, abundance mindset, financial literacy, and investing strategies are essential. They are essential life skills. They actually are, really. In today's economy, especially with AI, I believe that there's going to be investors and then there's everybody else.
Yeah.
Because when you lose your job and you don't have that,
there's a bit of a challenge there.
I mean, I started the investing accounts for my kids when they were 3 months old. That's how, you know, and Matt, right? Matt, because he wanted to beat that, so he started when they were like 3 days old or something. So he has the record right now, you know, setting up a junior ISA. So what about this one? Saving builds safety. Saving builds safety? Investing builds wealth. Saving builds safety. But is it really safe? Like you've got, but actually because of inflation, it's actually being eroded. So I would say, not even. I'll be honest.
No. I think
better than nothing.
No, it definitely is, because a lot of people don't even have a couple of hundred saved.
Oh, come on.
And that is a bit of a challenge. So again, when you are investing does build wealth, but it's all about what is wealth to you. Okay, is it enough just to get by? Is it enough to change your life?
Yeah, maybe.
Because that, again, it's just a mindset.
It's a mindset. But again, like I say, have bigger goals. I mean, wealthy people, we're going to talk this about the Wealth Creation Masterclass, which is coming up in a couple of weeks. We got to think bigger.
100%.
We got to demand more of ourselves and our money. And guess what? Miraculously, this is not rocket science, by the way. This is about your reticular activating system, noticing things because you are focused on it. It's like buying a new red Volkswagen. Suddenly, you're in your brand new red Volkswagen. Suddenly, you see all these red Volkswagens around the place. Hold on. Weren't they there before, Keith?
100%.
Of course they were there before, but your RAS wasn't actually activated. So as soon as your reticular activating is activated, that's what you're focused on. You see opportunities everywhere.
Mm-hmm. And I think one of the things that stuck with me is people overestimate what they do in the short term, but underestimate what they do in the longer term.
One of my favorite phrases.
It is true. Everyone wants get rich quick. But that's not what investing and trading is. Investing and trading is get rich for certain, meaning you are going to be able to compound it, but it's not going to happen in the next year.
Okay, so this is really important, right? What you just said, because then people will go, yeah, but then I'd rather do something else. It's not about doing something else. Do both. You've got to have 2 pillars at least, or three pillars. And what are people saying here? Leslie's saying you need a buffer of a few months' expenses before investing. Oh, yeah. So it depends. Is it 1 month? Is it 2 months? But I think 6 months is a bit much. Well, okay. Simi is saying maybe 6 months saving as an emergency fund and invest everything. Yeah, but again, Simi, why not have this? Why not have it in something invested, but that's liquid, so if you had to, you could get it back out again? Why not? Let's start investing. All right, so I want to show this. Can we actually show this screen? Is that okay? How do you find, I don't know where this came from, but how do you find the between investing in the stock market versus, honestly, I wish people could write. How do you find the between investing in the stock market versus saving for a house? I don't know what that means. However, How do you go about finding the balance between how much you decide to invest in the stock market versus saving for a house? I'm 26 and single. I fear that I'm losing out on the compound interest I'd see in the stock market by not investing. But I also fear that when I want to buy a house, the stock market will crash. And I will have to... Yeah, I get that, right? So that's the thing about investing. What if it goes down? Which we see as an opportunity, but then it might take time to come back up. And I will have to significantly adjust my plans. If I were to buy a house, I plan for it to be within the next 2 to 5 years. How are you all personally going about this? What do you think?
First point that I would look at is when you are buying a house, in the short term, is that an asset you've bought or is it a liability that you've owned? Okay, and for me, buying a house in the first couple of years, as you're paying back the equity of the house, it is a liability. It's
really
taking money out of your pocket.
Robert Kiyosaki says that. Grant Cardone says that as well. So basically, you should be renting the house that you live in. I was like, what? Like, wow, okay. I really had to get my mind around that. But investment properties, that's something else.
Because when you start doing like HMOs, buy-to-lets, the ones that are actually bringing revenue in, that cash flow, what you're using that for is to pay part of the mortgage off, and then you're making money on top of that as your income. Now, owning your physical house, again, renting is the way forward to begin with once you are able to build up a buffer. And that buffer, again, is something that you can go, right, I've now own my own house. I know in the next couple of years, until I build equity there, it's just going to be a liability taking money out of my pocket. But I've also got my investments side in the stocks.
So you're saying build up because Simi is with this guy, right? So, or woman, I don't know, but the 26-year-old, because he's saying, or she is saying, not sure I agree to investing the emergency fund, as that might be at a loss when you need it. So that's this scenario here. You're investing, everything's going well, suddenly it crashes, and you're like, Yeah, interesting. So you're saying basically rent while you're building up that buffer.
Yeah, and again, for this, is there going to be an opportunity in the next year to buy compared to, is there going to be an opportunity to buy in the next 5 years?
While you do that, let's ask them, right? What would you do in this situation? This is this 26-year-old, does he go and buy a house or... invest in the stock market? Well, I mean, it could be cryptos, right? This is, I'll tell you. Anyway, let's ask a question. What would you in this situation either focus on saving, right? Invest now, buy later, or a combination of both? Why does it say saving? Focus on what? Focus on saving. Oh, for the property. Yeah. Okay, number one is property. Focus on saving for the property, or invest now and buy the property later, or a combination. Ooh. All right, go ahead and let's have a vote. Let's see what people are thinking. This is really interesting. Okay, let's have a look. At the moment, it's 50-50, by the way.
It is.
That's so interesting. Go ahead. We're gonna leave that for another 5 seconds. And so, what are you saying? You're basically saying B, invest now and buy later, is what you're saying.
I'll tell you a story. Before, when COVID happened, I was in the process of buying my first house. I was going to move. I was going to get a mortgage. I had everything. I had a mortgage in principle. Everything set up. Then obviously COVID came and they cut down the mortgages that you were getting. Okay, so the value that you were able to loan on, they cut that down. So that then forced me to invest a lot more money in crypto. And if I tell you that was probably the best thing to happen to me in my investing career, that the mortgage rate went up, I couldn't then get the house I wanted to get, and I invested the other money
in XRP.
But in other cryptos, it was the diversification of that portfolio.
But it's just that XRP has just gone to an all-time high or something.
Yeah, I think it's 1,100% I'm up right now on XRP. So it's not too bad. But again, that happy coincidence that forced me to invest my money now has changed the position I'm in.
Wow. Okay. So we know you're definitely on camp B. Okay. Well, we have the results in. What would you do in this situation? It's 50-50. How the hell did that happen? Prioritize investing and try and balance both. Okay. All right. Very good.
Well, the good thing is we had 0% on focus on saving.
I think so. Maybe that was a little bit leading there because this whole thing is saving. Okay, so here's the thing. My money is safer in the bank. This mindset, and I get it, right? I get it. I get why there's famine. I get why there's war. I get it. I get why people think that, but I don't accept it. I think it's wrong, right? My money is not safer in the bank because you don't control it anymore, for one. So a traditional thinker, basically, with 10,000 saving in the bank, you get 3% annual interest, but inflation is more than that. Correct. So you're losing money. That's bad. An investor's mindset is 10,000 invested, whether that's stocks, whether that's cryptos, whether that's something else, and you can get 8 to 12%. When you know what you're doing, it's a lot more than 8 to 12%, my friends. A lot more than 8 to 12%. It doesn't matter which way the market goes. It really doesn't. And then you compound that to go even faster. Listen, if you want to do some in the bank, go ahead, but make sure you learn how to get your money moving. It's a currency. That is very important. So, do you have anything else you want to add here? Any secrets you want to divulge?
No, I think one of the biggest things is once you understand that the money in the bank is not going to make you money, you're then going to be forced to invest it elsewhere.
Nice.
But don't get into that mindset of, I want immediate gratification. Because once you start getting into that mindset of, I want the results now, you're going to take risky investments that actually lose you money and then stop you investing for the future. Just remember, it's a compounding journey. This basically means if you are following a strategy, you're making consistent returns, every 2 years you could be doubling your account. But it has to be consistent. It's not the work you put in now to see the results. The results you see now is the work you put in a couple of years ago.
Nice.
That's what people need to look at.
This is it. Small actions, but consistently done, whether that's every day or every week, but consistently lead to very big results. That's the whole idea. Now, let's discuss something else before we finish. We've got a few minutes left. Time in the market versus timing the market. What's the difference?
So trading, you're trying to time the best place to get in and out of the market.
Wait, now.
Oh, it's reached a low. This is the bottom. I'm going to buy, and then all of a sudden the market carries on lower.
Of course.
So timing the market is trying to find the best place to buy. Whereas spending time in the market, you don't care about the best time to buy. You are investing as the market does drop, but you're investing into the strongest assets possible. So if you're trading, you're trying to time the market. If you're investing, you're just finding the opportunities to compound your money over time.
Nice. So what do we prefer, time in the market or timing the market?
Time in the market for me, because I'm an investor. So all I care about is...
See, Dennis would disagree with you because he does both, obviously, right? It's all about asset allocation. You put some here. But he's really good at timing the market as well.
Yes, based on structure. But again, if you are a beginner with investing and trading and you only have 20 minutes a day, you just want to spend time in the market.
Well, but then don't do a buy and hold because without the knowledge, people automatically think, oh, so you guys just buy and hold. Well, anyone could do that. No. So we do something called active investing.
Yeah.
Whereas if something goes up, we start taking some profits. But when it goes down, we keep adding to it. And you can only do that in assets that you've done your research on. But actually, it's not a lot of research.
It's not.
It's not that much research.
You find the biggest companies possible. And you ask yourself the question of, can it go to zero?
Well, in the next foreseeable future.
Yeah.
I mean, eventually, most of them will go to zero, probably.
I say next 12 months.
Yeah, 12 to 24 months. And what, working, people talk about, like Robbie Kiyosaki talks about, you got to work smart. And people are like, what does that mean, man? And I always say, well, it's getting your money to work hard. Not you working harder, getting your money to work hard. And I think that, somebody, listening here today, they have a job or they run their own business. They're working hard, Keith, right? They're working, especially when you have your own business. It's like never ending. You wake up in the middle of the night with something. So it's really tough. But then don't have a second pillar, which is another 8, 9, 10 hours. Do something which is 20 minutes a day. But the market does the work. When you buy a stock of Apple, 100,000 employees are running around doing marketing, admin, advertising, aftercare service, and all this kind of stuff for you because you are an investor. You are a shareholder. That is you, not working harder. That's you working smarter. That's what that is all about. Yeah. And make sure that you counter inflation. Okay. So let's see what people are saying here. Money is not safe in the bank. Simi also says, interest rates are on the decline. So why mortgage property at these rates? Invest now and buy the house when interest rates have dropped. So he's saying wait a little bit. So he's agreeing with us there. Let's wait a little bit. So it's all about timing with property as well, or whether it's any asset class really.
And there's always a lagging event of interest rates falling before mortgage rates fall. So there is a bit of a delay.
Say that again. So
there's a bit of a delay from the time interest rates are falling to then the time mortgage rates also fall.
Okay.
So it is just a bit of a delay. So right now you could be looking at a fixed rate of maybe 5 to 7%.
But do you think that's coming down more though? Because Simi's kind of saying wait a little bit.
In the term of mortgage rates, it will come down more the more interest rates come down.
Yeah. Okay. Hey, listen, if you want to beat the banks, don't worry, we've got you covered. We have an amazing compounding calculator you might want to play around with. Teach your family. Just play around with it. You don't want them learning this information at the age of 90. Teach them this at the age of 19, because they're going to ignore you the first time anyway. They have to hear it several times. That's just the way we're wired, okay? So the link is in the chat below, unless we want to show this, but I think the link is in the chat below, and there's also the link. Is it like the compounding calculator? Have a play around with it. You'll be surprised. Yeah. And then people say, yeah, but Marcus, this is not real. This can't be true. You know, you start with 2,000, 3% a month is what we're going for, and then suddenly it's at 409,000, let's say. But what about taxes? And I will say, well, there's 3 ways to get about that, if not 4. There's your ISA, there's your SIP, there's spread betting, and the 4th one is actually a SAS, an SASS for business owners, which is another way of doing your pension, which is absolutely fantastic. Okay, so final thoughts: banks shrinks your savings due to inflation, but investing in assets grows your money. So conclusion.
Learn to invest.
Learn how to invest. Learn how to invest. Listen, because then we go, yeah, but there is no but. It's like my 6-year-old at the time saying, oh, no, I don't know whether I want to learn how to do this bike thing because, I might fall down and there's blood everywhere and she's crying and everything. I got it. I get it. Totally get it, right? Now get on the bike because you're going to need it. And so learn how to invest. There is no ifs, buts, or maybes on this one, my friends. Do this for yourself, do this for your family, but be a leader. You got to be the first. Fun Video says, apparently it takes 7 times of hearing the same thing before it sticks in their mind. Yeah, everyone's different, and it depends, how important it is to you at the time, right? If somebody's in a lot of pain, they'll probably get it a lot faster. But would you say that's true?
Yeah, repetition is the mother of all skills. You have to repeat it, but it's not just about repeating. It's then you have to take the action. You can hear the same thing 7, 20, 30 times.
Yeah, when is now a good time?
Correct.
Yeah.
So how much pain have you got to then actually take the action?
People don't have enough pain because we live in a rich country where they have enough to eat. They have a roof over their head. They've had a drink today, non-alcoholic. And so, well, hold on, it's 1:30, so maybe alcoholic. And so basically they have, what more do you need? But problem is, later on with inflation and the devaluation of your money, you're going to be in trouble. Good. Let's finish this off. Listen, I want to thank everybody for being here. People in the chat, people watching this a little bit later, and to Keith, of course. Next week's show, from teen trader to six-figure success. We have Taylor Becker in the house, who won our award. I think he made something like 328,000 or something like that profit last year. So using our strategies. So he's going to be in here. That is next week. You don't want to miss that one here. Get some of your teenagers watching this as well, because he was 18 at the time. He's 19 now. He's still a teenager. And if he can do it, you can do this. Thanks, everybody. Remember to take action. And we will see you next week at the Lunchtime Investor Show. Take care.